Imagine it is the 14th of September 2006. You are a 41-year-old high school teacher living in Phoenix, Arizona in the United States. Your name is David. You own a 3-bedroom house in a quiet suburb called Chandler, and you bought it 4 years ago for $220,000. It is now worth, according to your neighbor and the real estate agent who keeps sending you flyers, somewhere close to $380,000. You have a mortgage, which is just a long-term loan you took out to buy the house, and you're paying it down steadily month by month. You feel good. You feel secure. You feel like you made the right call. Your parents always told you that real estate was the one thing that never let you down. Land is finite, they said. People always need a roof over their heads. Property always goes up. And looking at that number, $380,000, you have no reason to doubt them. You have dinner with your wife on Friday nights at the same Italian place on Chandler Boulevard. You coach your son's soccer team on Saturdays. You sleep well. You believe you have built something solid, something real. If you have ever been told that real estate is the safest investment you can make, the one that always bounces back, the one that will protect you no matter what, stay with me. What you are about to hear is not a theory. It is a pattern. It has happened in different countries, in different decades, across completely different economic systems, and it always ends the same way for the people who believe the myth. And if this kind of historical clarity is something you find valuable, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Now back to David. Within 18 months of that quiet Friday dinner in September 2006, the house he believed was worth $380,000. It would be listed on the market for $260,000, and no one would be buying it. By 2011, the median home price in Phoenix had fallen roughly 56% from its peak. David still owed the bank most of his original loan. He had not done anything wrong. He had not been reckless or greedy. He had simply believed a story that almost every financial culture in the modern world tells its people. And that story, it turns out, is not the whole truth. This video is about that story, about why real estate, the asset that 2 generations of middle-class families were told was a guaranteed path to wealth and security, is not what it appears to be. And more importantly, it is about what history actually shows when you look at property markets across Japan, Ireland, the United States, Spain, Canada, and beyond. We are going to follow the evidence. We are going to look at the numbers. And by the end of this, you will never see a for sale sign the same way again. Before we go further, there is something important to understand. The idea that real estate is always safe is not random. It was built. It was constructed over decades by a very specific set of conditions that are not permanent. They are not natural laws. They are circumstances. And understanding this is the key that unlocks everything else in this video. Think of it like a greenhouse. Inside a greenhouse, certain plants thrive that could never survive in the open air. Warm temperatures, controlled humidity, protection from frost. The plants grow big and green and look incredibly healthy. But the greenhouse is not the natural world. The natural world has cold winters and dry spells and storms. The post-World War II real estate market in most Western countries was essentially a greenhouse economy. You had rapidly growing populations, a massive shortage of housing after the war, cheap credit, meaning loans that were easy to get and cheap to repay, strong wage growth, and governments actively supporting homeownership through tax breaks and subsidies. Those were the greenhouse conditions. And inside those conditions, real estate genuinely did perform like a near-perfect asset. But here is what almost nobody says out loud. Most of those conditions have now changed, or reversed entirely, and the plants are still being told they are in a greenhouse. The mechanism, the engine underneath all of this, is actually simple. Real estate prices do not rise because property is inherently valuable. They rise when 4 things align. Easy credit, meaning cheap loans, population growth, income growth, and restricted supply. When all 4 are present at once, prices go up and keep going up. When even one of those 4 reverses, the market becomes fragile. When 2 or more reverse together, the result is historically brutal. This brings us directly to the first major case study in this story, and it is one that most Western investors have heard of, but very few truly understand at its core. Japan, 1991. In the 1980s, Japan was the most impressive economic story on the planet. Its companies dominated global electronics and automobiles. Its banks were flush with cash, meaning they had enormous amounts of money available, and that money needed somewhere to go. It went into real estate. Japanese investors and ordinary citizens began borrowing enormous sums to buy land and property, believing that values would keep climbing forever. The Nikkei stock index and the property market moved together, each feeding the other in a loop of optimism and borrowed money. At the peak, in 1991, the land under the Imperial Palace in Tokyo was estimated to be worth more than the entire state of California. That is not a metaphor. That is what the math produced when you took the price per square meter of central Tokyo land and multiplied it out. The land under one palace, worth more than all of California. Then the Bank of Japan raised interest rates to cool the overheating economy. Interest rates are the price of borrowing money. When they go up, loans become more expensive. People borrow less. Buyers slow down. And when buyers slow down in a market where prices were only being held up by borrowed money, the floor disappears. Between 1991 and 2004, Japanese commercial land prices, the value of land used for businesses and offices, fell by 87%. Residential property values dropped roughly 60 to 70% across major cities over the same period. An entire generation of Japanese homeowners, people who had done everything right, who had saved diligently and bought property as their parents had advised, watched the value of their largest asset collapse and not recover for over 30 years. Japan is still, in many regions, below its 1991 peak in real terms, meaning when you account for inflation, property has not fully recovered. 3 decades. Think about what that means for someone who bought at the peak in 1991 at age 35. They are now 68. The asset they were told would be their retirement foundation has spent their entire adult working life recovering from a wound it still has not fully healed. Ordinary Japanese families experienced something economists call the balance sheet recession. That is a term that sounds technical, but it simply means this. When the value of what you own falls below what you owe the bank, you stop spending money on anything except paying down that debt. You do not buy new cars. You do not go on holidays. You do not invest in businesses. You just pay the bank, slowly, for decades. The economy stagnates. Prices stop rising. A slow-motion freeze sets in. It is not dramatic. It does not look like a crisis on the news every night. It looks like life, just a slightly worse version of life. For 30 years. Now here is something I want you to think about before we go further. Japan had a world-class economy, sophisticated banks, a hardworking population, and genuine cultural reverence for saving and property ownership. And still, their property market fell by 70, 80, in some commercial areas, nearly 90%. If it happened there in those conditions, what makes any other country immune? Drop your answer in the comments. Seriously, I want to know what you think. Because what I am about to show you next is the part of this story that most people never hear, and it changes everything. Ireland, 2000 to 2012. This is perhaps the most perfectly documented modern case of an economy that believed its own story so completely. The reality had to deliver the correction with violent force. In the early 2000s, Ireland was called the Celtic Tiger. That name itself tells you something. A small island nation that had transformed itself into one of the fastest growing economies in Europe. Dublin was booming. Property was rising 15-20% per year in some neighborhoods. Banks were lending aggressively, meaning they were handing out large mortgages to almost anyone who asked, sometimes with no deposit required. Sometimes for more than the house was even worth. This is called 110% mortgages, and it was real. Irish banks offered loans that covered not just the purchase price of the house, but the legal fees and the furniture as well. The idea was that prices would keep rising and everything would work itself out. Between 2000 and 2007, Irish house prices roughly tripled in many urban areas. Dublin went from being an affordable European capital to one of the most expensive cities on the continent. Young couples were taking on mortgages, 30-year loans, at prices that required both partners to work full-time, and still stretched the budget to its limit every single month. They did it because the cultural pressure was enormous. You were falling behind if you did not get on the property ladder. The media celebrated new apartment developments. Banks advertised mortgages with the confidence of someone selling a lottery ticket that was guaranteed to win. 1 in 3 homeowners owed more to the bank than their house was worth. Sean, a 32-year-old electrician, was trapped for years. Spain, 2007 to 2013. Between 1997 and 2007, Spain built more new homes than Germany, France, and the United Kingdom combined. That is not an estimate. That is a documented figure from European construction records. Spain was building at a pace that had no relationship to housing need. Between 1997 and 2008, Spanish property prices rose approximately 180%, nearly tripling in a decade. Then the crash arrived. Between 2008 and 2014, Spanish property prices fell by about 45% nationally. Spain ended up with an estimated 1 million empty homes, ghost developments, entire neighborhoods of empty apartments with roundabouts and streetlights and no people, became the defining image of the crash. At the peak of the Spanish crisis in 2013, unemployment reached 27%. Youth unemployment, among those under 25, hit 57%. Families who had bought investment properties found themselves holding assets that generated no rental income and could not be sold without losses. The Spanish banking system had to be partially bailed out by European authorities, with tens of billions required to shore up reckless banks. See, 2026, script scene splitter AI. Most people will never know what you now know right now about how these markets actually work beneath the surface. Most people will keep repeating that property always goes up, that it is different this time, that their country is special. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for, the part they never put in the textbooks, and the part the real estate industry has a very strong interest in making sure you never piece together. Now look at all three together. Japan, Ireland, Spain, different sizes of country, different cultures, different decades. Japan in 1991, Ireland in 2007, Spain in 2008. But observe the mechanism at work in every single case. The same sequence, every time. First, credit becomes cheap and widely available. That means ordinary people can borrow large amounts of money at low cost. Second, cultural belief in property as the safest investment intensifies. Property always goes up becomes the common wisdom. Third, construction or investment activity accelerates well beyond what actual population need would justify. Fourth, prices rise far faster than wages, which means incomes, creating a gap that only borrowed money can bridge. Fifth, a trigger event. Rising interest rates, a global credit squeeze, a banking crisis, removes the easy money from the system. And sixth, prices fall sharply. The people most harmed are those who bought late in the cycle, those who borrowed the most relative to their income, and those who had no other assets to fall back on. Real estate is not inherently dangerous. A greenhouse is not a bad place for a plant. But a plant that believes the greenhouse is the natural world will not survive the first winter outside it. The real danger is the belief that conditions are permanent when they are not. The danger is treating a historically unusual combination of cheap credit, growing population, and rising wages as though it is just the natural order of things, as though gravity somehow does not apply to this particular asset class. And here is where it gets deeply uncomfortable. Because the human cost of these crashes is not evenly distributed. It never is. In Japan, the corporations and the wealthy investment funds that held diversified portfolios, collections of many different types of assets, survived and eventually recovered. The ones who suffered most were the ordinary salaried workers, the ones who had put their entire savings into a single-family home. Because that is what Japanese society told them to do. For these families, the house was not one investment among many. It was everything. 90% of their net worth, meaning the total value of everything they owned minus what they owed, sat in a single piece of property. That was now worth less than the loan against it. In Ireland, the data is striking. A 2013 analysis by the Central Bank of Ireland found that the households with the highest levels of mortgage distress, meaning the most trouble repaying their loans, were overwhelmingly first-time buyers who had entered the market between 2003 and 2007. These were young families, people in their late 20s and 30s. They were not investors chasing returns. They were people who wanted a home, who were responding to cultural pressure and historically normal human instincts about security and stability. They got in at the top, and they paid for it with a decade of financial stress, restricted mobility, and in many cases, long-term damage to their mental health. In Spain, the groups most affected were working-class families in the construction sector, who had used the boom years to buy property, often using loans secured against the value of the house itself rather than savings deposits, and retirees who had invested in coastal second properties as a way to supplement pension income. When prices collapsed, the rental market. In coastal areas collapsed with them because it turned out much of the demand had been speculative, meaning people were not actually going to use those properties. They were just betting prices would keep rising. The retirement income these families had counted on simply vanished. The pattern is consistent across all three cases and across every comparable crash in history. The people hurt most are not the ones who took extreme risks. They are the ones who took the conventional, socially approved, culturally recommended path. They did what everyone told them to do. They trusted the safe option. And the safe option turned out to have conditions attached that nobody had bothered to explain. Those who came through best shared characteristics that the historical record makes very clear. And this is not financial advice. This is pattern recognition. This is what the archive of economic history shows about who survived and who did not. The question is not whether property markets have crashed before. History has already answered that with overwhelming evidence across dozens of countries and a century of data. The only question is whether you will see the conditions clearly before you are already inside them. If this channel helps you think more clearly about the world you actually live in rather than the world you were told you live in, subscribing costs nothing, and the clarity it gives you might be worth more than you expect. The historical record shows that those who came through property crashes, with their financial lives intact, largely shared three characteristics. Not two, not a dozen. Three. And they are simpler than you might expect. First, they were not concentrated. That is the technical way of saying they did not have everything in one asset. Across Japan, across Ireland, across Spain, across the United States in 2008, the people who recovered fastest were those for whom the property was one part of a wider picture. It was perhaps 30 or 40% of their net worth, not 90. When property fell, it hurt. But it did not destroy them because there were other things standing. Think of it like a table with 4 legs. When one leg breaks, the table wobbles but stays upright. The families who lost everything were the ones whose table had only one leg. The entire structure was real estate. And when it fell, they fell with it. Second, they maintained access to liquidity. Liquidity just means cash or assets that can quickly be turned into cash without taking a large loss. This is what allows you to survive a period when prices are falling and you do not need to sell. The single most dangerous position in any asset downturn is being a forced seller, someone who has to sell because they cannot meet repayments or because they have no other income. Forced sellers take whatever price the market offers. They cannot wait for recovery. Across every crash studied here, the people who avoided catastrophic outcomes were the ones who did not need to sell. They had cash reserves. They had low enough debt that they could continue making payments even when income was reduced. They could wait. Patience in a down market is only possible if you are not financially drowning. Third, and this is the counterintuitive one, they had thought about exit before entry. Before they bought, they had asked not just will this go up, but also what happens if it does not. What is my monthly cost if prices fall and I cannot sell for 5 years? Can I still afford the loan payments if interest rates rise by 2%? If I lost my job, how many months of mortgage payments do I have in reserve? Most people entering a property market at a cultural peak of enthusiasm are not asking those questions. They're asking how quickly can I get in before prices go higher. The survivors were the ones who ran the downside scenario before they signed the paperwork, not after. Now let us come back to David, the high school teacher in Phoenix, Arizona, in September 2006. You left him feeling good. A house worth $380,000. A solid marriage, soccer practice on Saturdays, the Italian restaurant on Friday nights. By early 2009, the Phoenix market had collapsed. David's house was worth roughly $190,000 on the open market. He owed the bank just over $200,000 still. He was, in the technical language of the crisis, underwater. He owed more than the house was worth. The equity, meaning the portion of the house's value that actually belonged to him, was wiped out. He had not missed a payment. He had not done anything reckless. He had simply bought a house in a city that experienced an aggressive boom and subsequent bust in American history. David did not lose his home. He kept making the payments because he had a stable government job as a teacher and because he and his wife had no other major debts. That stability, the public sector income that did not disappear. When the private economy collapsed, it was what saved him. He stayed. He waited. By 2014, the Phoenix market had partly recovered. By 2019, his house was worth more than $300,000 again. He made it through, but it took 13 years to recover what had been wiped out in 3. 13 years of watching that number, of turning down a job offer in another state, because selling would have meant crystallizing a loss he could not absorb. 13 years of a financial shadow over decisions that should have been free. Not everyone in David's neighborhood had his stability. His neighbor, who worked in mortgage origination, the business of writing new home loans, lost his job in late 2007 when the lending industry contracted. Without income, he could not maintain payments on a house worth less than the loan. He lost the house to foreclosure in 2009. He moved to a rented apartment. He rebuilt slowly. But the decade of wealth he thought he had accumulated in that house simply did not exist. It had been a number on a piece of paper supported by conditions that evaporated. The lesson is not that real estate is bad. The lesson is that no asset is unconditionally safe. The word safe, when applied to any investment, always has conditions attached. Real estate is safe when credit is cheap and population is growing. And wages are rising and supply is limited, and you bought at a reasonable price relative to your income, and you have adequate liquid reserves. And you are not a forced seller. Remove 2 or 3 of those conditions, and the asset that felt like solid ground becomes something quite different. The historical record across Japan, Ireland, Spain, and the United States delivers this verdict clearly and without sentiment. Property markets move in long cycles. They can fall by 50, 60, even 80% over periods of years. They can take a decade or more to recover in real terms. They can trap ordinary, responsible, hardworking people in positions of negative equity that restrict their lives and their choices for the better part of a working career. This does not happen because people are foolish. It happens because the story told about real estate is incomplete. It tells you about the upside. It whispers about the downside. And the downside, when it arrives, does not whisper back. Understanding this does not mean avoiding property. It means understanding property clearly. The way a doctor understands a medicine, knowing both what it can do for you and the conditions under which it can harm you. The investors and families who navigated these crashes with the least damage were not smarter than everyone else in some abstract sense. They were more honest about risk. They had refused to let cultural enthusiasm replace their own clear assessment of the numbers and the conditions. They had held the question open, what if I am wrong? And that simple, uncomfortable question turned out to be worth more than any amount of optimism. This is historical and educational analysis. It is not financial advice. Every individual situation is different. The patterns described here reflect historical events and do not guarantee that any particular market will behave in any particular way in the future. Please consult a qualified financial professional before making any significant financial decision. History is a guide. It is not a guarantee. This video is not for everyone. Most people will hear this and go back to believing what they have always believed, because the alternative requires thinking carefully about something that feels safe and familiar. But if one person in your life is about to make a large financial decision based on the idea that property always goes up and can never truly hurt you, share this with them, not because it will change the world, but because it might change their world. Subscribe for more of this kind of historical clarity, and I will see you in the next one. The analysis of market mechanisms shows consistent patterns in every region. From Tokyo to Dublin to Madrid, the symptoms remained identical. Credit expansion always preceded the peak. Cultural consensus always justified the high prices. Construction always ignored the demographic shifts. The disconnect between earnings and valuations reached a breaking point. Then the external shock arrived, and the easy money vanished overnight. Those who survived were those with diversification, liquidity, and a planned exit strategy. They understood the gravity of the cycle. They knew that safety is conditional. Real estate is an asset class like any other, subject to the laws of supply and demand. By studying the past, we gain the clarity to navigate the present. Honesty about risk is the ultimate financial asset. The human cost of these cycles is real and lasting. We must look at the numbers, not the narratives. We must ask the hard questions. Clarity over optimism, pattern recognition over conventional wisdom. This is the path to surviving the volatility of the modern market. Thank you for watching this deep dive into economic history. Stay informed, stay questioning, and always run your own numbers before signing. Knowledge is the only real protection in a world of shifting cycles. Take these lessons into your next financial chapter. See 2026 Script Scene Splitter AI GitHub.